In a market that usually moves in whispers, a number this large is supposed to be impossible to hide. About 150 million ounces. That's the reported scale of strain that showed up in the plumbing of London silver, a figure so big it stops being commodity talk and starts sounding like an engineering failure. And it didn't unfold over months, not weeks, but in a compressed window where the signals tightened. Fast, spreads distorted, and the physical flow began to behave like it was being pulled harder than it could comfortably respond. They said this could never happen in a modern liquid market. They said paper and physical would stay stitched together by arbitrage, by inventories, by the invisible hand that smooths everything out. Yet the contradiction sits right in front of us. The screen can look calm, while the system behind it, the screen is stressed, borrowing, substituting, delaying, and quietly repricing the one thing paper cannot print: deliverable metal. This is the part most people never see. Institutions watch the pipes, not the posters. They track what leaves vaults, what gets leased, what gets rolled, what becomes expensive to borrow, what suddenly requires a premium, and what starts taking longer to deliver. And when those pipes tighten, they act before the public narrative catches up. Information asymmetry isn't a theory in metals, it's the operating condition. What I'm about to lay out changes how you interpret every normal silver move from here. Because once you understand where pressure actually builds, you stop asking why price didn't react yesterday, and you start watching for the moment the system is forced to react today. Welcome to Channel Name, where we decode what matters before it becomes headlines. If you've been here a while, you know the routine: filings, flows, and the strange places where official numbers and real-world behavior disagree. If you're new, consider this the kind of place you come back to, like listening to that wise elder who doesn't raise their voice but always seems to be early. And drop a comment with where you're watching from, because this story is global and the demand is not coming from one corner of the world anymore. Now, what actually happened? Start with the deficit math that's been building quietly underneath the price. 9 million ounce shortfall in 2024. That's not a rhetorical number. That's a supply and demand gap large enough to matter in a market where inventories are not infinite, and where much of what exists is already spoken for by industry, refiners, and long-term holders. And the forward look didn't flip to surplus. 6 million ounces. Smaller, yes, but still a hole that has to be filled by drawing down something somewhere. At the same time, trade flows started speaking louder than the daily chart. India's silver imports were reported up about 129%, and a striking portion of that flow was tied to China as a supplier. That matters because it hints at a world where silver is not just a Western investment narrative. It is an industrial input, a strategic import, and a balance sheet asset that moves through customs forms long before it moves through your newsfeed. When import behavior changes that sharply, it's not a mood swing, it's a shift in urgency. Then you look at the mechanics that tend to show up right before stress becomes obvious: margin and collateral changes. Late in 2025, the largest futures clearing infrastructure in the world published new performance bond requirements for metals products, effective after the close on December 29th, 2025. If you've watched this movie before, you know what that means. When requirements shift, leverage changes. When leverage changes, positioning changes. And when positioning changes under pressure, the market can move in ways that have nothing to do with what people believe and everything to do with what people can afford to hold. All of that set the stage for the central mystery. How can the physical market be described as strained to the point of seizure, while the price action often looks like routine noise? How can a commodity that's critical for electronics, solar, and industrial processes also be scarce enough to trigger emergency behavior in the world's key clearing hubs? To answer that, we need the hidden pattern. Silver has a long memory, and it tends to repeat itself in sequences, not in exact price levels. In 1980, an attempt to control supply collided with the reality of rules, margins, and forced liquidation. The result was not just a dramatic move, but a lesson about who controls the game when the system feels threatened. In 2011, the market surged, and then the structure responded with a series of margin increases that altered the behavior of participants. It moved because the cost of carrying risk changed, and here's the key. In both cases, the early warning wasn't the headline number on a chart. It was the distortion in the mechanism. Tightness showed up in spreads and delivery behavior. Borrowing became expensive. Premiums rose. Rule changes arrived. And then, after the system had already been adjusted, the story was explained to the public as if it were a surprise. That sequence is what makes the current setup so important. In 2024, the deficit number tells you the market was drawing down something. In 2025, a still large deficit tells you the drawdown continued. And into late 2025, the combination of import surges, reported London strain, and clearinghouse margin updates tells you the people closest to the pipes were preparing for volatility in the plumbing. To make that pattern undeniable, look at how silver behaves when the world is forced to price time and trust. In 1980, the lesson was simple. When concentration meets changing rules, the market can flip from euphoria to liquidation in days. In 2011, the lesson repeated with modern tools. As prices surged, the exchange raised margin requirements multiple times in quick succession, and the move that followed was not a philosophical shift. It was mechanical. The cost of holding risk rose overnight, leverage became expensive, and participants dependent on borrowed money were forced to cut positions. A third parallel is less famous because it played out in commerce. In 2020 and 2021, supply chains fractured, shipping slowed, and retail premiums on coins and small bars often moved independently of spot prices. People could look at a quoted silver price and still struggle to source product at anything close to that level. That wasn't a failure of arithmetic. It was a reminder that the quoted price is a reference point, not a guarantee of availability. Notice the common thread across these episodes. First, stress appears as friction, delivery delays, higher premiums, unusual spreads, and sudden changes in financing costs. Second, institutions protect the system. Margins adjust, rules tighten, and liquidity providers step back. Third, the public narrative catches up and calls it volatility, speculation, or a surprise. But the pattern shows pressure in the plumbing becoming visible only after the system has already been forced to respond. This is why the phrase "buy together" matters. Coordination does not need to be explicit. It can be structural. If solar demand rises globally, if electrification expands, if defense and aerospace procurement increases, and if multiple large importers decide to secure supply in the same quarter, the effect is the same as coordination. The same limited float is being requested by many hands at once. Silver is unusually sensitive to geography. A bar in the wrong place, under the wrong ownership category, can be effectively unavailable. When flows lean east, Western vaults tighten. When Western investors accumulate, industrial users feel it first. And when a major hub like London shows strain, it matters because London is not a mine. It is a distribution and financing center. Stress there signals that the market is repricing logistics, financing, and trust. Here's the part many miss. Deficits can persist longer than expected because the market can borrow supply from the future. Stockpiles can be drawn down, scrap can be incentivized, substitution can occur at the margin, but each response has a cost, and each reduces the buffer that makes the system feel stable. When the buffer shrinks, small shocks create outsized reactions. A fund can gain exposure with a click. An industrial buyer cannot. A trader can roll a contract forward. A manufacturer cannot roll a production deadline. A vault report can look unchanged while the availability of bars, in specific locations, in forms, quietly deteriorates. That is how a market can appear liquid and still behave brittle under real strain. 6 million ounces, you're not just seeing 2 annual statistics. You're seeing the buffer being consumed. And when, on top of that, you see surging imports and signs of hub stress, you're seeing the shock absorbers wearing thin. Now let's talk about the players, because this is where many nations' buying becomes meaningful without turning into fantasy. When multiple countries accumulate the same material, they do not do it in a press conference. They do it through import channels, state-linked procurement, industrial policy, and the steady work of purchasing that looks boring until you add it up. They build inventories for manufacturing, they secure supply for energy transitions, they stockpile strategic inputs. They do it because silver is not a luxury. It is a conductor, a reflective surface, a chemical component, and a key ingredient in technologies that governments openly say they want more of. On the public side, you can see this as a pattern of rising import needs and aggressive sourcing. On the private side, you see it as a competition for the same physical pool. A production line needs a certain amount on a certain date in a certain specification. If that becomes uncertain, the rational response is to secure more than you need and secure it earlier than you planned. Multiply that logic across multiple industries, and the effect looks coordinated even when it isn't. Banks and market makers sit in the middle of this, managing inventory and risk. In a calm market, they can provide liquidity by selling paper exposure and hedging it with physical leases, swaps, or other instruments. In a stressed market, that web tightens. Lending metal becomes less attractive. Holding inventory becomes more valuable. And providing easy liquidity starts looking like volunteering to be the last one holding the problem. Exchanges and clearinghouses add another layer. Their job is not to make prices rise or fall, but to keep the system solvent when volatility appears. That's why they adjust performance bonds. It's a safety mechanism, but it also changes behavior. If the cost to hold a contract rises overnight, a leveraged participant may have to reduce exposure, even if they were right about direction. That forced adjustment can look from the outside like a sudden change in sentiment, but inside the system, it's accounting. And then there are refiners, fabricators, and vault operators, the people who live in the real world of bars and logistics. When physical is abundant, they operate like a conveyor belt. When physical is tight, the conveyor belt becomes a triage system. Certain clients get priority. Certain locations become premium, certain forms of metal become harder to source, and that shows up as one of the most important signals in commodities, the difference between a price for delivery later and a price for delivery now. This is where it gets interesting. A lot of people talk about silver as if it is one market. It isn't. It is several markets layered on top of each other. There's the paper market, futures, options, and synthetic exposure. There's the wholesale physical market, large bars, vaulting, leasing, unallocated accounts. There's the industrial market, long-term supply contracts, fabrication schedules, just-in-time delivery. And there's the retail market, coins and small bars, which is loud, emotional, and very visible, but not always the driver of wholesale tightness. When those layers are aligned, price behaves like a single story. When they separate, you get dislocation. The dislocation now looks like this. On one side, you have price action that can appear restrained, sometimes even sleepy. On the other, you have physical signals that are anything but. Reports describing London strain on the order of 150 million ounces. Deficit accounting that says the world consumed more than it produced for years in a row. Import surges that suggest major demand centers are accumulating. And infrastructure moves that tighten leverage and risk tolerance at key clearing points. Two markets tell opposite stories. This gap cannot persist forever, not because of drama, but because of physics and incentives. If physical metal is scarce, it becomes more valuable relative to promises of metal. That value does not have to show up as a simple spot price spike right away. It can show up as higher premiums, tighter lease rates, sudden backwardation episodes, and a shift in who is willing to part with inventory. If physical is abundant, those signals relax. What matters is that the system always expresses the truth somewhere, even if it refuses to express it in the headline price at first. Now, proof with numbers, because narratives without numbers are just bedtime stories. 9 million ounces. Put that in context. If you think of silver as an industrial input, that's a material gap that has to be covered by drawing down stockpiles, substituting supply that would have gone elsewhere, or persuading holders to sell. 6 million ounces. That is not a one-off event. That is continuation. Anchor 3 is the reported scale of London strain, around 150 million ounces. Whether every ounce is missing or simply unavailable at the right time, the number describes a scale of tightness that changes behavior. Then add the trade flow shock. India's reported 129% jump in imports. If demand were fragile, that number wouldn't exist. If supply were loose, the urgency behind such a surge would be hard to justify. And add the institutional mechanical lever. The futures clearing performance bond changes effective after the close on December 29th, 2025. That date matters because it marks a point where the system preemptively increased the cost of carrying risk. So what does it mean when those numbers coexist? It means the market is being pulled in two directions at the same time. Paper markets want liquidity and smooth functioning. Physical markets want certainty and availability. Industrial users want supply regardless of short-term price turbulence because production lines do not pause politely. Strategic buyers want metal in hand, not metal promised. And when all of those desires converge, the most fragile link becomes the place where metal must actually be delivered. That brings us to the mechanism, how this can be executed without anyone needing to announce it. Think of the silver market like an airport. The departure board can look orderly. Flights listed, times posted, gates assigned. That's the paper layer. But the real constraint is the runway and the maintenance crews. That's the physical layer. If the runway is congested, the board can still show on time until the last possible moment. Then suddenly, everything changes. Delays, reroutes, cancellations, and new rules about who boards first. Margin requirements are like changing the price of a ticket and the size of your carry-on at the same time. If the exchange raises the cost to hold a position, some passengers cannot afford to stay in line. They leave. That creates forced selling or forced covering. Not because they changed their mind, but because the rules changed under their feet. In a leveraged system, rule changes are events. Leasing and unallocated accounts are like standby tickets. They function when there are plenty of seats and when trust is high. But if too many people show up at once, standby becomes a problem. The system can borrow metal, swap it, lease it, or delay it. It can move bars from one vault to another. It can encourage rolling of contracts by making immediate delivery expensive. It can widen spreads so that right now carries a penalty. Each step is rational for the institution managing risk. Each step is mostly invisible to the casual observer watching only a chart. And here's a subtle point that matters. Scarcity doesn't need to be total to be destabilizing. The world can have enough silver in a broad sense and still experience acute shortages of deliverable, properly refined, properly located metal at the exact moment it is demanded. That's how supply chains break. Not because the planet ran out of a material, but because the material wasn't where it needed to be, when it needed to be there, in the form it needed to take. This is why the paper versus physical debate keeps returning. Paper can promise delivery in theory. Physical has to deliver in practice. When the system is healthy, the difference feels academic. When the system is stressed, the difference becomes the story. So what does the data suggest going forward without turning this into a prediction contest? Historically, when persistent deficits combine with rising strategic demand and signs of delivery stress, one of three broad paths tends to emerge. The conservative path is a slow repricing of immediacy. Premiums rise, lease rates tighten, spreads distort more frequently. Price may grind rather than spike because the system finds ways to ration demand quietly. If that continues, the indicators to watch are repeated backwardation episodes, persistent tightness at key hubs, and continued import strength from major buyers. The moderate path is a sharper repricing triggered by a mechanical event, a new wave of margin. Changes, a surge in delivery requests around a key expiry or a disruption in a major supply channel. In that scenario, price can move quickly, not because of emotion, but because participants are forced to rebalance positions in a short window. The indicators to watch are abrupt shifts in futures spreads, unusual warehouse reclassification activity, and heavy volume concentrated around delivery windows. The aggressive path is about credibility, a moment where enough participants demand the same thing simultaneously and the system has to choose between altering settlement incentives, paying exceptional premiums for immediate metal, or restructuring how delivery is managed. In that scenario, the price you see becomes less important than the price required to source metal right now. The indicators to watch are extraordinary spread behavior, emergency sounding policy language, and persistent reports of delays where normal delivery timing no longer applies. Notice what all three paths have in common. The market tries to avoid admitting stress in the headline price until it cannot. It prefers to express stress in spreads, premiums, rules, and delivery behavior first. That is the pattern. Now we arrive at the divide, and it has nothing to do with being smarter than anyone else. Some people follow stories, others follow systems. Stories arrive late because they require consensus. Systems signal early because they require only math. The information gap becomes a wealth gap, not because anyone is evil, but because institutions are paid to watch the machinery while the public is sold the poster. Institutions move first. They always do. They cannot wait for headlines. They run risk books. They manage procurement. They respond to deficits and shortages as operational problems, not as entertainment. Retail tends to arrive last because retail is invited only after the narrative is safe enough to broadcast. If dozens of nations and industries are quietly pulling on the same supply at once, the question is not whether the market notices. The market notices immediately. The question is how long the notice can be confined to places most people never look. And that brings us back to the title, What Happens When They Buy Together? The honest answer is that the mechanism, not emotion, decides the pace. If the pull continues, the system will keep repricing immediacy in the ways it always has, through spreads, premiums, rules, and eventually price. The story won't look dramatic at first. It will look like a series of small, technical changes that only make sense in hindsight. And then, one day, it will be explained as if it were inevitable. This is Channel Name, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Keep watching the pipes, not the posters, because the moment the system is forced to reconcile paper promises with physical reality is the moment the chart starts telling the truth out loud.